Okay, we're coming into the difficult season for stocks. The crash season, when you're going to have a crash, typically occurs between August and October. Sometimes starts a little earlier or ends a little later. So, the markets have been going up and up and up, just as they've been since the Trump win back in late 2016. So, yeah, and we've been expecting that, and still the broadest, what we call technical indicators, do not suggest that we have a big crash coming ahead. The markets are clearly probably due for some sort of correction after doing so well, and you've got resistance with the S&P 500 testing its highs from January. NASDAQ's been at substantial new highs already. The Dow is not as close, nor is the broader New York Stock Exchange indicator. So again, I would expect some sort of correction coming here. The $1 million or $1 billion question here is, do we see a sharper and deeper correction than would be normally expected? Normal, and what I call scenario one here, and still the more likely scenario from all indicators, is that maybe we go back and retest the lows that we've had a couple times in 2018 around 23,400 on the Dow. Again, that's the most likely scenario with everything I see here. But, this is a different market. As you know, it's been artificial boom, and especially stock market bubble since the 2008-2009 recession and the massive quantitative easing, now 15 trillion and rising around the world, and tax cuts on top of that from Trump, and another one on capital gains to favor higher income people, likely just ahead. So the economy's doing good, but although that's not sustainable, as I've showed in many articles, and Obama had a couple of 4% plus quarters, and none of them lasted. So, what happens if we get a surprising top here? What do we kind of retest the highs, and that's it? Now there is one indicator which I've shown in the 5-day forecast for our boom and bust subscribers, that the smart money index has been crashing all this year. It went up right into the top in January, late January of this year, 2018, and said, hey, that run up was okay. They weren't moving out ahead of that. It's been ever since. The markets corrected into February and off and on into April, May, and have been straight up ever since, as usual. The smart money has not been buying into this rally, as this indicator shows, and it's the sharpest downturn in this indicator we've seen in the last 10, 20 years, sharper than the one coming into the 2000 big bubble top, sharper than the correction after the 2007 top and all that sort of stuff. So this just may be a sneak indicator that most people don't watch, that may be saying something. And again, my big concern is that no indicators work well in an artificial economy that's been generated by $15 trillion of free money through QE, and now another $1 trillion plus through tax cuts, and more to come. It's not a real economy. Our fundamental indicators don't work like they did, because this is what the economy's running off. It's not running off fundamentals. If it were, we would already be in a depression by now, and the worst years are in the next couple of years on our demographic and other key indicators. So we are going to get a crash. Right now, I would suspect the most likely scenario is we do see a smaller correction now, 10, 15%, whatever. And then we have one more rally with this next round of tax cuts and everything else into next year. And then on the 90th anniversary to the 1929 to 32 crash, and then the other Great Depression and reset back in the 1830s and 40s. This is a 90-year cycle, and it's probably the most powerful cycle for the stock market we have, and the greatest resets. Now, but what if the market does go down faster than thought. I mean, we've got this trade war with China that's heating up and could heat up more. The dollar is tending to go up, and that's not good for the markets, and it's very bad for emerging markets and China, which are down, by the way, 20%, give or take. That's a big divergence. We're not getting the divergences in the stock market in the U.S. between large and small caps that's typical, but small caps are favored by the trade war, so that indicator may not work this time around. What if the smart money index is right here and we get a sharp crash? So here's what we all need to look for. And again, I'm going to be on this big time, and it's going to be a big topic at our Rational Economic Summit in late October in Austin. If we see a correction into the last part of this year, or even into January or February possibly, that's the danger zone. If that happens and we get more than a 20% correction, and it's very sharp, and especially we get 30% plus, that would say we have seen a second top here from January, new highs in some indexes, not in others, and that this bubble is starting to burst, and we need to get much, much more defensive. So that's what I'm looking at. I'd still, you put a gun to my head, I'd say, no, we're going to get a more modest correction, and we got one more good run. And it's just an extension of what I see is the final wave up. We call them fifth waves in Elliott wave patterns. So this is the fifth of a fifth of a fifth of a fifth of a fifth, all the way back to the American Revolution and the greatest bull market in history. Again, with two big 90-year great resets that I mentioned earlier, and we're coming up on that next one. So it says this next crash for all types of reasons, especially because it's been so extended by artificial stimulus, this boom and bubble. But just on this 90-year cycle, we got something big coming in the next few years. Question is it topping near term, or will it top latter part of next year? Those are my two most likely scenarios, and I'm split. I'm still favoring the peak next year. But again, the next couple months ought to tell us a lot, and I will keep you updated.